Good evening, folks. My name is Jeff Hooper. I'm the Chief Operating Officer here at Ackerman Group, and I want to welcome you to our webinar tonight. We've got an exciting topic and a couple of great speakers. So we are really looking forward to a good session tonight. We're certainly glad you took a little time to join us. This is the second in our series called Selling My Veterinary Hospital. This is an education series that we offer. We've been doing this now for a couple of years. This series is going to run through 6 sessions. We did a couple of weeks ago, our session was when is the right time to sell your practice. We had about 75 attendees to that one. That was a great session. Tonight, talking about what the heck is EBITDA. Great topic there. We got, as I mentioned, a guest speaker. We've got our own Steve Haas is also going to join us tonight. So looking forward to that topic. In 2 weeks, we're going to talk about hiring the right advisors. Those of you that are considering a practice sale certainly should get some help. If you don't get help from us, you get it from somebody. You need CPAs, you need attorneys, you need financial planners. It's important to have a good team around you when you start thinking about transitioning your practice. We're going to dive deep on that topic. March 23rd, we're going to talk about everything you should know about corporate buyers. They're not all the same, and kind of give you a few things to look for when you start negotiating or talking to corporate buyers. And then April, we got 2 great sessions. The first one, the sale process, kind of the start to finish process of selling your practice, what you might do to initiate and who to negotiate with, taking it all the way to the transition that you desire. And then at the end of April, the 27th, we're going to talk a little bit about, kind of what to expect in the marketplace. It's been very volatile last several years, and especially with COVID last year and a little bit of a pause in the corporate buying market, but things seem to have heated back up. So we'll kind of give you a feel for where the market is and where we think it might be going. We'd like for these sessions to be as interactive as possible. You guys are all on mute, so you can ask questions a couple of ways. You can either type your question into the Q&A button if you see that on your screen. There's also a chat function. If you see the chat window, you can pop up and just drop your question in there to any of our speakers at any time, and I'll make sure that those questions get answered. If you would like to just, ask your question in person, there's a little hand button on your screen. You can raise that. I'll see it come up, and I will call on you for to ask your question. So. We've got a lot to cover tonight, so I'm going to turn things over to Gary. Our topic tonight is what the heck is EBITDA? So Gary, why don't you take it away? Tell us a little bit about Ackerman Group and tee up our conversation tonight.
Jeff, thanks very much. And we're happy that everybody's on this call. This has been a call we've done a couple of times because EBITDA is a central part of any of the veterinary transactions that we've been doing. And so we're trying very hard to get the veterinarians that come to this call and anybody else in the industry that is welcome to come and listen to what we've got to say and our thought process to these calls. That we are just really happy that everybody can attend, and we post these calls on our website so that if you missed the call or you want to come back and listen to it at sometime down the road, or you want to know what our thoughts on different things, we're an open book on it. We think that we should be talking the same thing no matter who our attendees are on the call. So we're happy that we have a lot of people here. I'm here talking because I'm the president of Ackerman Group, but I'm also a veterinarian that owned multiple veterinary practices for 20-some years. After I left that, I have been advising and brokering on practice sales since the late 90s. Started out doing 1031 exchanges on veterinary practice buildings back in the late 90s and early 2000s. And people liked minimizing the taxes on the building sale and things like that so much that we started doing sales through family LLCs and trusts, things like that on the practice sale, and ended up getting a number of financial advisory licenses and managing the investments for the people that were selling the practices. And it came from doing that work, doing the tax work through 1031s and managing the investments, that I really got involved pretty heavily on the practice sales side. And we saw the stuff we handled was some of the larger transactions, and we saw some really good ones come in the door, and we saw some come in the door that, we had no idea who was negotiating, but almost universally it was actually the veterinarian doing the negotiating, and we thought there maybe might be a nice situation to get a little bit of help. So since then, initially as part of the financial advisory service, but ultimately we went over and started a brokerage firm too. We've been doing brokering of practices almost full time since 2016. And since that time, we've easily done 100 corporate practice sales. We've done 70 plus joint venture and private equity sales. We've probably had at least 30 of those come full cycle. So we have a pretty good idea what it looks like on both ends of that. And what we really like to do is work with you on the holistic approach. And that's basically integrating with you not only on your sale, but with your financial advisor, with your tax planner, your CPA, with anything that's material to the planning of the things that are associated with your transaction, because you're typically going down multiple paths at the same time. And so our goal is to really assist you in that. It's not to do it, but it's to make sure you're paying attention to all the things that you should be. So we work with a lot of outside experts, and we actually have a couple of them on the call tonight. So that's a good thing. So Ackerman Group as our process is, we've got a certain process we like to run you through, and as kind of a model for when we work with a practice. And basically what we're looking for is to put you in a situation where we can go and look and find you the right company for you to work with. We're looking really for the best fit. We're looking for something that comes in from the companies that are out there that meshes well with what your practice is doing. The personality of your practice, your staff, your associates, things along that line. What we're looking to do is bring in a company that really isn't going to change you, that's going to have, you're going to have a comfort with, as far as the the computer systems they're using, and the lab systems they're using, and the vendors they're using, and things like that. Our main goal really is to bring in somebody that's going to mesh really well, because in most of our circumstances, our selling doctors are staying on for 2 or 3 years. Our staff, everybody wants to continue to work with their staff in the same manner that they were working. And so, our goal really is to put you in a position to where you've got the company coming in that you want to be a partner with. Concurrently, we're also looking to potentially get you, the right terms. We're always looking for the best fit and the best terms for you. And the terms that we see on this are, everything from your employment agreement to your lease agreement to, if you're in a joint venture or you're in private equity, to make sure you're getting with the right company that's got some financial upside for you to invest in it. It could be, you could have holdbacks, you could have earnouts. There's numerous things in here that are the second or third layer of terms on a practice transaction that comes after price or company. And then the third leg of the stool is the price. We work and we put groups of practices together and take them to market. And when we're taking these groups of practices together, we are generally able to find a better pricing scenario for a lot of people, because when we're taking 10 or 15 practices to market at the same time, we have companies that we'll treat that as kind of a little mini platform or a bigger group, and we'll get some price or some terms that we're not necessarily going to get on an individual practice basis. So that's kind of where we're working on it. And an integral part of this is the EBITDA of the practice. Okay, so the whole piece here is, what the heck is EBITDA? That's where we are. And so the first thing I would tell you about EBITDA, is the accounting definition. I mean, it's the earnings before interest, taxes, depreciation, and amortization. And everybody knows what that is. That's why we get so many questions about EBITDA from everybody out there. And what we're going to talk about today is how we normalize your EBITDA. And I'm not going to get into this extensively on this slide because I don't want to steal from our speakers, but basically we're going to take your numbers and put them in a fashion so this would be the earnings that the purchaser of your practice would have. And in normalizing it, we're just putting back some of the expenses that you have chosen to incur that your purchaser might not choose to incur similarly. It's important because this is the number that you're going to get paid on when somebody buys your practice. And the calculation of it is I look at it as the secret sauce. In theory, it should be something that would be a fairly routine formula, to calculate. But when we're talking to 5 or 6 different companies and we're calculating an EBITDA and your CPA is calculating an EBITDA, we come up with 8 different numbers. And so there is some secret sauce to how everybody does this. We're going to try and give you a little bit of a look underneath the hood as to how the CPAs will do it, how we do it when we're looking at practices and trying to put it out there for companies. And then we'll talk to you a little bit about what we see companies doing. Somewhere in here, we're going to talk some about how you can influence it in your practice, and obviously this is, how does it drop down to how do the corporate buyers view it? So this is kind of the table of contents for what we're going to be talking about today. But I think it's good that you can see that there's some things that are going to be on your tax return that are going to going to work on your profitability, but there's only certain things that you're going to be adding back when you're calculating EBITDA. So in short order here, what I'm going to do is I'm going to turn this over to somebody who knows, or 2 people who know a whole lot more about this than me. And the first one that I'm going to turn this over to is Glenn Hanner. Glenn has been teaching veterinarians and working with veterinarians for many years. I've taught a number of classes with Glenn, and he's just what we're talking about here. He's great. And so with that, Glenn, I'll let you step up and talk a little bit about yourself and where you're working on EBITDA with all your clients and where you see it on transactional items.
Sounds good. So my name is Glenn Hanner. I'm a CPA and a partner with Whitley Penn, and I run the veterinary medicine practice for Whitley Penn. And we are a regional accounting firm. We work with clients all over the country. We have about 650 team members, and we're spread across 8 offices in Texas and New Mexico. And in my practice, I lead a team of about 25 people that specializes in the veterinary profession. And so we serve both small and large animal practices, and right at about 100 practices in 23 states is where we're at today. And I'm old when I look at these numbers, but I've been doing this for 35 years now. So we've seen a lot of changes in both the profession as well as the market as a whole. I currently am on the board of directors for Vet Partners. I'm the former co-chair of the Valuation Council with Vet Partners, and we'll talk about some of the resources that Vet Partners Valuation Council has put together towards the end of our conversation here. And I, along with Lorraine List, were the co-authors for the American Animal Hospital Association's book, Selling Your Practice. So anytime we have a conversation about value, that always starts with profit. Profit is you're going to know by the end of the day is what's going to drive those numbers. And so to have those good numbers, you got to have a good accounting system, and you got to have you got to think about what it is that you need, not only to run the practice. I mean, we're going to talk about value today, but the reality is, when we talk about value, we're talking about profitability driving value, and it's not just achieving some profitability number as much as it is actually having profit that you can take out of the practice and live on. So rather than wait till the end and try to get to drive your profit numbers up to get a higher value, let's talk about doing it now and realizing those the cash flow through the years. But in any system, your numbers that you get out are only as good as what you put into it. And so I think this is where Whitley Penn as a firm adds value to our clients. And that is, we design the accounting system to where not only do we give you numbers to be able to manage the practice, but then those numbers make sense when you start talking to a buyer, and the buyer can see that where everything went and how the money flows in and out of the practice. So when they start calculating their profitability numbers, they know they have good numbers to begin with. So in any system, you got to make a choice of cash versus accrual. And honestly, we do accrual accounting with our clients because I think that best matches the revenue and expenses, but it's not a big deal to me whether we do cash or accrual. Cash accounting just means when you deposit an amount into the bank, that's when you receive, or that's when you record the revenue. And when you write a check or charge something on a credit card, that's when you record your expenses. Versus the accrual method is when we actually record the revenue when the services is provided, regardless of when you get paid. And in your profession, that's pretty much on the spot anyway. But on the expense side, it's not. You may buy from a supplier today and not pay for that till the 25th of next month. And so to better match that expense with the income, we're going to, on the accrual method, we're going to account for that when you incur the liability, not when you pay it. And then by the time we get to the tax return, it's probably a combination of things. Even though we do our clients' books on the accrual method, we convert them to the cash method when it comes to actually preparing the tax return. So, Gary talked about EBITDA and profitability earlier. One of the things that we see is people equating what comes out on the bottom of their profit and loss statement of their income statement as their profitability. And you look at things, versus what ends up being profit from a value orientation is not profit from a tax perspective. And so we're going to make some changes, and Steve's going to go into some of those changes in detail. But basically, we take the income statement and we adjust it for items that the new buyer, whoever that buyer is, whether it's an individual or corporation, we're going to normalize those to what that buyer would have to, or what it would look like for that buyer to run your practice, taking out the things that may or may not be truly operational expenses. And in the end, what buyers are looking for is consistency. They want a consistent profit year in, year out, where they can count on. When we talk about value, we're talking about value in terms of an income stream. And so if you have a large profit this year and a small profit the next year, it's tough for a buyer to get a grip on what that income stream is going to be. And so that's what they want. They're looking for consistency. So the system needs to be designed to capture the income and expenses on a consistent basis. And one of the things that's happened to us recently is we've representing on somebody on the buyer side, and we're seeing that the practice they're buying stopped making repairs. They stopped spending money on cost of goods sold. And so we had a huge swing in cost of goods sold in the fourth quarter. Percentages went way up, and we asked the buyer, and it turns out they stopped buying drugs and supplies so that they could affect that profit stream. So, the consistency of the accounting system is important. And if you got personal items running through those books, then clean up your junk by all means. You need to get it out of there so that the buyer can see the true books. There's only so much the buyer is going to be willing to allow you to add back, and we're going to talk about what those add backs look like. But when you have so much of your personal things running through the books, you've got to get them clean so that the buyer can see what they're buying and what they're paying for, what that revenue stream is going to look like. Okay, let's go to the next slide. So talked a little bit about EBITDA and what that means, and it truly is a mathematical equation. It's just taking your net profit and adding back the interest, taxes, depreciation, and amortization. And how that differs from profitability is that there are certain things in everybody's books, and it's not necessarily a bad thing, but there are certain things in everybody's books that whether it's paying yourself a minimal salary to save on FICA Medicare, or whether it's you pay yourself a different rent because you're in a state that charges sales tax for rent. There's all kinds of reasons why we may not pay the true numbers in our income statement. But when it gets to profitability, what we're really looking for in these adjustments is what does it look like for the buyer to operate your practice? And so, the EBITDA versus the adjusted EBITDA means that you're going to take your EBITDA, which is truly just a mathematical equation, and you're going to add back and you're going to subtract things. And we have the Vet Partners Valuation Council has a profitability estimator worksheet, and we'll give you the link to that here in a little while, but you can actually take your income statement and make the adjustments to see what true profitability is. Because like Gary said, when you look at what a buyer is going to do and what adjustments the buyer is going to make, you never know what you're going to get. And we like Gary see this all the time, is that the CPA will normally do some adjustments, not really understanding the veterinary market. And so they make adjustments in a traditional business valuation sense that don't really apply to the veterinary market. And so, when you start talking about getting offers from 3 or 4 or 5 different buyers, you're going to get a different number from every one of those. And the reason for that is, well, there's a couple of reasons. One is that every one of them has their own model that they're going to run your practice through. So they have their own operating model, and they may make adjustments to, regardless of what your cost of goods sold are today, they may make an adjustment because they know what they can get their cost of goods sold to. And one may be different than another. So there really is no number. And the reason why you get one offer for $1 million and $1.5 million from another is because they have different operating models and they view your practice differently. And we even see it within the same buying group among different practices applying different methodologies. So sometimes they're not even consistent within themselves. And if you're part of a study group that compares and normalizes the financial statements, you may be in a group that normalizes your, let's say your rent to a 6% number. And so you take everybody in the group, regardless of what they pay in rent, normalizes their financial statements to a 6% rent figure. And that's to help compare across the different practice groups within your study group. But if you're in a high rent district and you're paying 10 or 12% rent, and you've adjusted thinking your profit, you've adjusted to 6 and thinking that's your true profitability, that's not your number, because whoever buys the practice is going to have to pay that same 10 or 12%. So then you look back and those adjustments don't equal true profitability, even though they equal the comparability between your group. And if you have one-time expenses, whether that be repairs, remodeling, painting, things that aren't normal operating outside of the normal operations, then those are some of the adjustments that we are going to add back. And then, we talk in terms of tax returns and whether or not the tax return tells the story of profitability. And we do a lot of things on a tax return to save tax. And if you're running personal items through the tax return, just to give you an example of what that might look like when we talk about value, is if you have let's say you have a $10,000 worth of personal expenses you're running through your books right now. And so that saves you, I don't know, maybe 30 or 40%, so $3,000 or $4,000 in tax. But then you turn around and depending on what the offer is from the corporate side, you may be impacting your value $80,000 to $100,000 to achieve that $3,000 or $4,000 in tax savings. So hopefully by the end of the talk today, you'll be able to have a grip on what EBITDA means and how to calculate your true profitability. And to that end, we have some publications that if you go to vetpartners.org, there's a resource tab at the top. And then within that resource tab, there's a valuation tab. And in the evaluation tab, you can download this NOLO publication and then the profitability worksheet. And it'll take you from your net income on your income statement all the way down through a true profitability percentage that you can kind of get a grip and start thinking about what your true profitability is.
Glenn, thank you very much. And I'll pass along some other words of wisdom related to the NOLO practice and the profitability here. We in many circumstances, we're both the bearer of good news and the bearer of bad news. And in the current market, when we're doing some of the corporate transactions, valuations have been very, very strong, and people's profitability has been very, very strong. And so the good news we're bearing is pricing on your practice. It's been just extremely positive, and COVID has actually helped. The bad news is that we're bringing to you some estimate as to your tax liability. And generally, the better you do on your practice sale, the more your tax liability is going up. So we try to integrate that in the planning that we're doing somewhat. But I'm also the bearer somewhat. We do evaluations on basically everything that comes in the door. We're going to take a look at your profitability, see where it is, and give you an idea based on comparable sales what your practice would sell for. And maybe 20–25% of the practices that come in the door need to be reading this NOLO practice brochure, because we can sell practices all day long at most any profitability level, but the question is, are you leaving chips on the table? Your best return on investment could easily be putting some management skills into managing your practice. And so some of the times the best advice that I can give people is not sell their practice, but go work on their practice for a year or two. And so, this is like owning an IRA or some stocks in the stock market and not checking them until the year before you retire. It's not prudent. And this is the one thing that you as an owner can also influence. And so, in that vein, I think this is, we're happy to help you look at this. The Vet Partners is happy to help you look at it. But if you're not looking at it, you're not managing your practice investment. It's pretty simple. So in that vein, the next step we're going to get into is I'm going to bring in Steve Haas. Steve works with us, and boy, am I glad that he works with us, because he has really helped me in teaching me how to calculate profitability, the different things that we're looking at when we're normalizing that. Steve does a great job, just tremendous amount of experience, and we're not only happy but lucky to have him. And so I'll turn this over to Steve. He's going to walk you through a little bit of what we do when we're analyzing a practice, which is similar to what most of the companies are doing. So, Steve.
Great, thanks, Gary. Again, I'm Steve Haas, and my role at Ackerman Group is that I oversee the financial analysis part of the process that we go through. So really all the practices that we work with, I'm involved in working with the owners on evaluating their financial statements and normalizing their profit and loss statement. So a little background about me is I've got a little over 15 years in the veterinary industry. I got my first foray into the industry back in the mid-1990s, where I helped a group of veterinarians merge their hospitals under one corporate structure. And then we went out and actually purchased other hospitals across the country. So National Pet Care Centers was formed by a group of veterinarians, including Dr. Ross Clark, Dr. Gary Burge, and a few others. And once we merged the hospitals together, we ended up purchasing other hospitals. And we ended up with about 75 to 77 veterinary hospitals in our group that were located over 13 states. Primarily, they were west of the Mississippi River, although we did have some practices on the East Coast. And we ended up selling National Pet Care Centers to VCA in the mid-2000s. I've also worked with veterinarians in a consulting capacity, analyzing their financial statements and working with them on operational improvements in their business. And then I've had some experience in non-veterinary industry capacities, working with some early stage startup businesses. And about a year and a half, 2 years ago, got put in touch with Gary and others here at Ackerman Group and came on board to help them with their financial analysis process and help grow the business. Okay, Jeff, go to the next slide. So again, both Gary and Glenn have talked about why you normalize EBITDA. You do so because the financial statements of a veterinary practice don't really show the true EBITDA, because there are other expenses in there that are not really necessary to run the business. So if you just look at your P&L that your CPA or accountant is providing you, it doesn't really paint a picture of what the true normalized EBITDA of the practice is. So I want to walk you through kind of how you normalize EBITDA, and I'll take you through the process that we do here at Ackerman Group. And as Gary and Glenn mentioned, different buyers and different firms will calculate a different normalized EBITDA, but the process they go through will be very similar to what we do. They're going to start with your financial statements, make adjustments, and then that arrives at their normalized EBITDA. So when we're going through our analysis, adjustments in 5 different buckets. So one are personal expenses. Practice owners will run through their P&L, meals and entertainment that they have for their family, maybe trips they take, although maybe not so much now in the COVID era, but trips they take that are more personal in nature. They will run through vehicle expenses, maybe automobile leases, gasoline expenses, maintenance and repairs. There's a whole host of personal expenses that get run through that aren't really necessary to run the business. So those expenses have to be adjusted. The second bucket that we look at is what we call owner compensation adjustments. Now, this incorporates both the owner and the owner's family. We want to make sure that the expenses that are in the payroll account are fair market value for what services the owner and their family are providing. So when we look at an owner's compensation, we kind of compare what they're being paid through payroll to their production at the practice and some of their management responsibilities, and see if that's a fair market value. Sometimes owners are paying themselves kind of, whatever they want, which may not be consistent with what would be paid if they were on a production-based compensation. Other times they might be not paying themselves anything. They might just be taking a draw out of the practice, and so their P&L has no expenses in there for their production or their management. Similarly, for their family, they could have a spouse that's working as a practice manager that's either getting paid through payroll or not getting paid through payroll and just taking a draw out. They could have kids that are on the payroll that are not working at the hospital, or they could have kids that are at the hospital that are doing business-related activities, kennel attendants, receptionists, things like that. So we look at the adjustments in that owner compensation category, sort of our second bucket of adjustments. The third category are non-recurring expenses. These are also like one-time expenses. So if you're doing any, you're remodeling your exam rooms, you're doing a computer conversion, and you're incurring expenses to get technical support to help you convert the data from one computer system to the next. You are buying pieces of medical equipment that you were running through the P&L as an expense. Those are all non-recurring one-time expenses. So we want to make sure we have some adjustments for those in normalizing your EBITDA. The fourth category is fair market value rent adjustments. So if you own the practice and own the real property, we want to make sure that the rent that's incorporated into the P&L statement for your practice is somewhat reasonable based on other lease and rents in the area, based on your sort of evaluation of what you think would be charged in that area and things like that. So again, that's another fair market value rent adjustment. And then the last category or bucket that we have is what we're calling fair market value operational adjustments. These are basically any other adjustments that don't fall into the other four categories. So there are things like, buyers want to make sure that there's an appropriate level of CE expense in the financial statements. So sometimes, especially now in the COVID era, there might not be much or any CE expense in a practice. We need to make sure that we factor that in. Similarly, there are some expenses like utilities, telephone expense, if you're paying rent to a third party, where you would expect one monthly payment per month, so 12 months of payments. But depending on when you as an owner may pay your expenses, you might pay an expense 2 or 3 days early, and that might end up showing 13 payments on the 12-month period that we're looking at. So we need to adjust that 13th payment out because it's not really part of the representative 12-month payments that you would see on a typical financial statement. So those are really the 5 buckets that we use to normalize a hospital's EBITDA. And the next thing is the importance of the general ledger in normalizing EBITDA. One thing that buyers look for is not just for us to say there's $25,000 of personal expenses that we're backing out. We need to show them the exact amounts and how they tie to the general ledger so they make sure that there's some backup for the adjustments that we're making. So what we'll do is we'll look in the general ledger and we'll actually go sort of line by line for the different expense categories. And one, we'll make sure that we can tie the adjustments we're making to the general ledger, but also we'll be asking you as owners questions because we may see some expenses that appear to be one-time expenses or non-recurring, or it could be a personal expense that we wanted to verify with you and make sure that that's the case so we can add that back. Part of our process is that we'll ask you for a list of personal expenses, one-time expenses, and if we're looking at calendar year 2020, for example, expenses that you incurred in October, November, December might be fresh in your mind, but expenses back in January, February, March of 2020, might not be as fresh. So by us looking through each line item in the general ledger, we're able to make some notations to talk with you about things to see if there are other items we can add back. And once we get done with this whole normalization process, we arrive at what we can support and defend as a normalized EBITDA to the buyers. As Gary and Glenn said, a buyer might calculate EBITDA differently, but they'll look at our analysis and we'll be able to say, this is why we made this adjustment. So this is why we added back this piece of medical equipment, and this is why we added back this landscaping that was a personal expense and things like that. So when we're done with the whole process, we feel that we have the documentation to support our adjusted EBITDA number, and we can sort of, and defend is not the right word, but we can really defend it to potential buyers to show them why we made those adjustments. Okay, Jeff?
Yeah, sorry, Steve, just another question came in, which would probably be good to chat about
Sure.
right now. Just to kind of reinforce what you're telling everyone about the personal expenses. Question is personal expenses, excess owner compensation, non-recurring expenses, rent adjustment, operational adjustments are added to EBITDA. The question is really around, what that does to the purchase price. I think this individual has got some, had been told by one company that those adjustments actually would decrease the price. So can you just make it clear on, how those
Sure.
adjustments being added back to, what effect the adjustments have on the net EBITDA?
Sure. For the most part, the adjustments that are made, 90% of them are adding to the EBITDA because they're removing that expense from the financial statement. So say that and I'm just making up numbers here, say your EBITDA is $100,000, but in your expenses, you have $10,000 for automobile expense, your personal car lease, gasoline charges, and so forth. We would go in and remove that $10,000 of personal expenses, which a buyer should be doing too, because paying for an owner's personal vehicles is not really a business expense. So then the EBITDA is not $100,000; it actually would increase to $110,000. So the purchase price would go up. Now, there are some situations where instead of removing expenses, we have to put expenses in. So for example, I mentioned for owner compensation, say that you're set up as a sole proprietorship, and so you can't really pay yourself a salary. So there's no salary going through payroll. You're just taking out draws, which do not hit the profit and loss statement. In that case, we would look at the production that you produce at the hospital and factor in a fair market value compensation for you by putting some expenses back in, which does lower the EBITDA. But again, when you sell your practice, you're going to want the buyer to be paying you for producing revenue at the practice. So any expenses that are removed on the income statement will increase your EBITDA, and any expenses that we put back in will decrease your EBITDA.
Hey, Steve, just another comment on that. Probably some of the bigger things that we see that would decrease coming in the door. We see health insurance adjustments fairly commonly. That's probably a big one where there's not as much health insurance being provided as a company will, because they're having to be Obamacare compliant. That's they have to offer across all their practices. That's a fairly common one. The other one, sometimes we see practices that don't have a practice manager, and most of these people the companies run a manager intensive process at most of them, so we would generally end up adding in an employee for that. So those are kind of some of the possible things that we might see, that where the adjustment would be a negative adjustment instead of a positive adjustment.
Yep, exactly. Yep. So actually, and this may actually be a little more clear as we're talking about two examples here, because I'll touch on those items here. So I wanted to show and walk through kind of a high level example of normalizing EBITDA. Now, when we get a hospital's profit and loss statement, it has all the detailed categories of expenses, and we'll go through all those detailed categories and make adjustments to them. Then what we do is we group those expense categories into 5 main expenses. One is cost of goods sold. The other one is compensation and benefits. The other one is general and administrative, which are things like advertising, office supplies, computer expenses, things of that nature, maintenance and repairs, and so forth. Then there's a real property expense, which is rent for the practice, utilities, real property taxes. And then we have an other expense category, which might be continuing education, some staff meals for the staff and so forth, and some other miscellaneous expenses. So in this example, we have a hospital that's doing $2.5 million. And on their profit and loss statement for the trailing 12 months, which is what TTM stands for, because we look at a 12-month period, after having all their expenses, EBITDA comes out to $275,000. So they're showing an 11% EBITDA margin. Now, some of the characteristics of this hospital, there's high owner comp relative to their production. They've got a spouse and family members that are on payroll but not working at the hospital. They've repainted the exam rooms, put in some new computers, new servers, and they own the real property. So in this example, I'm showing the adjustments that we make. We have some minor adjustments in cost of goods sold, adding some expenses back. So again, expenses go down. But the biggest category, again, for this practice with these characteristics is in the compensation and benefits category. We're actually removing expenses or adding profits back in of $150,000 because, again, the owner was paying themselves higher than what their production and management would necessarily result in. They also had their spouse and family members on payroll, but they weren't working in the practice. So we added those expenses back. Then under general and administrative, we added back the one-time expenses for repainting the exam room, new computers, new servers. And on the real property taxes or real property expenses, we made an adjustment to get their rent to more of a market value. And again, for the characteristics of this practice, we assumed they were paying themselves a little higher rent than the market would indicate. So based on all of our adjustments, we actually moved their EBITDA from what they're showing of $275,000 up to $500,000. So their EBITDA increased from 11% to 20%. And I would say most of the hospitals, we do show an increase in EBITDA from what the hospital is reporting on their own to what we end up showing because of personal expenses, non-recurring expenses, and those sorts of things. But the next example I'm going to show is one where we actually show a decrease in EBITDA. And again, it's related to the compensation category. So Jeff, if we go to the next slide. So in this one in Hospital B, I assume the same $2.5 million hospital. But in this case, the owner has no compensation for themselves at all, in the compensation benefits expense category. So that $825,000 that's showing under the reported trailing 12 months category has no compensation for them. Also, their spouse is working as a manager, but they're not on payroll either. So the owner just takes out draws to transfer money from the hospital into their personal account and everything. And then I assume for simplicity in this one that the real property is owned by a third party. So in this example, because they're showing a profitability of 32.5%, but again, as we go in and look at the expenses of the hospital, we have to make sure that the hospital has expenses that are going to be recurring and part of the business going forward. And certainly compensating the owner for their production, for their management time, compensating their spouse for working as the practice manager, if they're going to continue in that role, or if they want to not continue that role and another practice manager comes in there, we have to have that particular compensation in there. So in this example, the adjustments, we actually had to increase their compensation benefits and related expenses by $287,000. So that then resulted in the EBITDA going from 32.5%, which they were showing on their internal profit and loss statement, to 23% as a normalized ongoing EBITDA result, which again, the practices we see, EBITDA can range from 18% to 26, 27% on average. There's going to be hospitals which are higher than that, and there's going to be some which are, lower than that. But in general, kind of in a bell-shaped curve, you've got 18 to 26, 27%. So, being in a 23%, even though the EBITDA was lowered, that's what a buyer is going to look at because they want to make sure there's compensation in there for the owner, for the practice manager, and for anyone else who's working in the hospital but just not getting paid because they're a family member. Okay, Jeff?
Yeah, Steve, another on this same topic, those are great examples, but the question came in about, do you also add the amount to reflect how the purchaser is going to save money on administrative expenses? Obviously, when they buy a practice, there's some economies of scale. That's why they're doing it. Does that add to EBITDA is the question. The purchaser is probably more efficient and, for instance, taking over payroll and those kind of things. Does that add to EBITDA before the acquisition?
It's a great question. There are certain expenses that we do add back. For example, accounting and legal expenses. A buyer is going to have their own internal, CPAs and accountants and so forth. So a hospital is not going to be incurring an expense for their outside accountant, outside CPA, because the buyer is going to be assuming that role. Similarly, legal expenses, and I don't mean legal expenses related to the sale, because those would be non-recurring and removed anyway. But if there are legal expenses to do contracts for doctors or any other kind of legal question that would come up, rather than currently you're calling your own attorney, the buyer will have sort of a legal department and HR department to sort of handle those issues. So those are expenses that we also add back on our end in calculating what our normalized EBITDA is.
Hey, one more comment on that, Jeff. The buyers are looking at all of these practices that they're going to get some economies of scales across administrative expenses, across cost of goods, across a lot of different things because their cost structure is different. But in general, they're looking to accrete those cost of goods and other savings to them after they purchase, rather than they may be looking at what they think they can do when they're calculating their sale price and things, but they're certainly not going to build it into the EBITDA that they calculated on a trailing 12 months basis for this existing practice.
Mm-hmm.
That's great, Gary. Another good question came in. This one might be for Glenn. It's the question is around really taking the cash, I guess, from rebates from drug companies and credit cards, and whether or not that should be deposited and run through the practice. Maybe you could address that, Glenn. It's probably a common occurrence.
Yeah, and we have clients that we don't really want to know what they're doing, but we do have clients that are cashing those checks, and they're cashing or using those credit cards for personal uses. But again, when you talk about a $4 or $5 or a $10,000 rebate, what that equates to in the value of your practice versus what you do with that. And many times you end up squandering is not a good word, but you end up having to use it on things that you might not even spend that money on. And so yeah, we from a multitude of reasons, we put those through there so we get to a true cost structure. So we know what operations are, and the decisions we make around running the business are made with real numbers. And two, you're selling yourself short on EBITDA, which ultimately turns into value.
One other comment on that too. We see the same thing when we're normalizing. Steve and I struggle with this across many different practices, and rebates are not that difficult to get added back on a normalized basis. We see a lot of rebates that don't end up on the books. You can add them back as just a decrease in your cost of goods, which will help your EBITDA. Credit card statements are a little bit different because there's really hard to discern exactly what created that rebate and things, and a lot of times it's in a personal name. So, what we found is that if it's not going back in the company hopper and credited towards cost of goods or stuff like that, it's a lot tougher to get those credited back as normalized. And so if you're utilizing those in any way, shape, or form, at least the year before you go and sell your practice, make sure they make it in the bank, because it's a lot easier. Anything that's not making it in the bank, my general rule of thumb is you're not going to get full credit for it.
Steve, another quick question for you. I think, can you normalize your bookkeeper out? I think as long as it's not your mother, you're probably got an option there.
True. Yes, generally the bookkeeper role at the hospital is going to be undertaken by the buyer. So that's a position. If it's just a bookkeeper, that's all they do, then that role is typically not going to be moving forward. If the bookkeeper is also does inventory management and does other management of the practice and so forth, then we have to have kind of a discussion as to the role and everything. But generally, if it's a traditional bookkeeper, that role is assumed by the buyer going forward.
Here, back over to you.
Okay. So we've had this discussion about normalizing the EBITDA. Glenn's had a discussion about how to, on an ongoing basis, work on your EBITDA and make it better. The other thing that we wanted to go into is, what are the corporate buyers? How do they look at it? And they're going to go through, as both of them said, a very similar process. They've got their own secret sauce they're going to put on it as far as what their ranges are going to be for health insurance or cost of goods or things like that. But ultimately, even though these are, numeric calculations. They're also a little bit subjective as to what people put in there. And so you may come up with different numbers. It's probably, if we're dealing on a transactional basis, it's probably Steve, Glenn, and I, all of our job to try and make sure they're as accurate as possible, that we're going to bring back in there things that are expenses that would not be assumed by a purchaser. We want it, what we've really tried to do in these is to be real transparent. When we go out to buyers, we're literally going down to the line item in the general ledger, and looking at it so that we can show every single thing that is being added back and why. I mean, literally to the transaction. We see numerous companies that will take your P&L and they're going to reconcile it back to the tax return. And sometimes we see differences between the P&L and the tax return, which is always an interesting thing to try to explain. And so we will then, we're going to try, and sometimes we have to reconcile, just like personal expenses. We have to understand what's showing on the tax return and why it might be a little bit different from the profit and loss statement. Most companies take the position that the final number and the accurate number is the tax return, okay, which is generally the area where most of the practice owners like to minimize their income. So just trying to make sure that everybody knows how it works. In that event, the other thing we wanted to chat a little bit, one of the questions we get from everybody when we're calculating stuff is, why is it higher in this? What's causing it to be higher or lower and things like that? The companies, most of what we see, the EBITDAs are probably 16 to 25%. They're going to be somewhere in that range as a range. But the companies, sometimes I think if it's below 16%, they get a little bit excited because they think they can do better, and we probably think you could also do better, and so we may even get a higher multiple on something that's a lower profitability range because they're building in some pro forma numbers, some projected numbers. Where we see a lot of heartburn is some of the practices come in where their EBITDA is over 30%, and we see a fair number of practices that are in that range. And there's a concern on the part of the buyers that it's not going to be reproducible, or it's not going to be continual, and that they can't continue to manage the practice in that manner. And so we start seeing some hedging on offers and putting in caveats or earnouts or different things along that line when we get into the higher number, higher percentage EBITDA range. So. Hey, Glenn, I thought I'd let you comment on this one. I hate to put you on the spot here, but I know you get into the weeds on this regularly as far as all your clients and stuff. This was some of the different things that we had that we've seen as far as what, and this is actually kind of a hybrid of a couple different companies. I'm interested in what you see, if that's in the ranges that you see also.
No, I think so. I think if you look at, I think cost of goods sold across the board has slipped. If you look at historically, I mean, we look at the BMG, the large BMG practices. Historically, they've been in around 20% cost of goods sold, and we've seen those numbers slip to 21, 22% recently. I think all of these are good numbers. I think the facility cost we see, probably base rent closer to 5%, but it's in that 6-7% overall total cost. When you look at administrative cost, most of the joint ventures we see with buyer groups are coming back in that 3 to 5% range that they're hitting the practices for. And so those are the numbers that you need to be striving for, because that's what they're going to adjust to when they look at that. And I guess the comment I have, you talk about the large ranges of EBITDA, and we had a situation in this past year where we had two almost identical practices that both sold to corporate groups, and one of the practices just chose not to run it. They didn't choose on purpose, but they chose not to do what it takes to get profit where it needs to be. Let's put it that way. And their reasoning was, with the dollars that the corporate groups are paying, it really doesn't matter what their cost structure is, they're going to get a good number. And these were two specialty practices, and they got a great number. They got an $18 million sales price, but an almost identical practice. got a $26 million sales price. So they still got what they called crazy money, but that still, it matters. I mean, you've got to manage, if not for any other reason than to take the profit personally. So you got to manage to run the practice like a real business. That's the bottom line.
Well,
Thanks. Another question came in, Gary. I'm sorry, Gary, do you want to comment on that first?
No, I was going to add that the last thing I was going to comment here was the buyers normalizing to their expected percentages rather than what the actuals were on the practice. We see a fair amount of that too.
This question is about just capital expenditures and how that affects EBITDA. We're adding laser therapy and ultrasound to our services. How is this calculated forward to affect EBITDA? Obviously, we're expecting to have probably an increase in income, 25,000 to 50,000 in 1 year. So how does that affect the EBITDA calculation if you're in the process of selling one, I guess, and what advice would you give someone that's contemplating that sort of a capital expenditure?
Well, if you really want to get the EBITDA from it, then you need to wait a year and put it in place because then you would have it. The companies are going to be cognizant that it might raise your revenues associated with that. If it's a capital item and you haven't run it through your drugs and supplies, then it's not going to really drop to your bottom line significantly. But you're not going to see, the EBITDA is done generally on a trailing 12 months basis when we're doing the analysis. And so it's not going to come in and affect you other than, a company might put a little dollars towards it in their own internal calculation if we made the case that these other services are coming on board, or if you were farming them out, then some of this was going to stay in house. Then there certainly might be some numbers that they would presume that they could add into, but I don't think it's going to affect it dramatically. I don't know, Glenn, you had any experience on that differently?
No, I don't. I mean, they pay on cash flow. So if there's no cash flow from it yet, then it's not going to go into the equation. But the EBITDA is going to be computed based on cash flow. So buying a large capital expenditure in a year that you're going to sell the practice, to me, doesn't make any sense.
Another question came in here. This might be for Steve, but maybe in one of your examples here. The question is, do gross wages, the percentages here include payroll taxes, workers' comp, and profit sharing, et cetera? And when you're talking about the total comp and
right. Yeah, in the examples I gave, the 5 buckets, the compensation, benefits, and related, that includes gross wages, employers' payroll taxes, any health insurance benefits, profit sharing, workers' comp. Yes, it includes anything that's a compensation related type amount. And again, those were just some examples. So we'll see hospitals that have ranges based on the mix of services they have. Do they have a lot of specialists or no specialists and things like that. So in the examples that I gave, I think one of them was at 44%, one was at 43%. Those are somewhat reasonable after normalizing the wages for the owner and their family and that sort of thing. And you can see on the examples I gave that starting out, I think one of them was at 50% because one of the characteristics of that particular example, if you want to go back, Jeff, to the hospital A example. So in that one there, it's at 49% for compensation, benefits, and related starting out. That's because the owner was paying themselves a higher salary. They had their spouse on the payroll who wasn't working there and that sort of thing. But when we normalized it, it got down to 43%, but that would include all those other items, the workers' comp, any profit sharing for the staff, 401k for the staff, if there's a matching contribution that the hospital makes and that sort of thing.
Got it. Yeah, I think some of the confusion maybe from the question here is that these numbers here are broken out. So we've got DVM costs and staff costs with workers' comp and benefits being separate here.
But if you add them up, Jeff, they're 43%, which is right where Steve was coming to on the other one.
Exactly.
Yeah,
that might be the confusion on the coming from the audience there.
Yeah, this slide here breaks into 3 different
Yep.
costs, but it's still in line. Yep.
Quick question for anybody, I guess. How is the PPP loans, how is that adjusted? How does that affect EBITDA? Who wants to grab that one?
Can we take that?
Yeah, go ahead.
So from a book perspective, to adjust you borrowed the money, so you have a liability in your book. So when you get forgiveness, that comes back as income from a book perspective. It's not income from a tax perspective, it's tax-free income. And so it'd be one of those things that Steve would adjust back out. So it's going to be an extraordinary item. And
Right.
even though it's going to be showing as other income on your income statement, you're not going to get credit for EBITDA.
Correct. It'll show up on your income statement, but again, it's not going to be a recurring income amount every year related to the business. So it'll be removed.
Just another comment on that. If somebody is considering a transition and they do have a PPP loans, those have been a huge hurdle to getting some closings done. Some of the issues we've had related to them, there's a bunch of rules from the SBA related to those on businesses which are being sold. So if you have those and you're contemplating a transition, you should reach out to us to discuss, or if you've got a veterinary attorney, they should be pretty familiar with it. There's just make sure you start with lots of runway to get those done, because the lenders are not speedy. And that's one of the things that certainly put some glitches in some of the transactions we've tried to close.
Gary, this might be a question for you. Do you find that buyers change how services are credited to DBMs, like in terms of, I guess, paying post-sale? This would change the percentage compensation one way or another.
Yes and no. I think there's some standard ways to pay for services to vets. Vets should basically be paid on services which they produce, in an exam room and things like that. If we've got vets that are being paid on services or things like that are being produced by other people, or over the counter stuff or refills or different things like that, then yeah, we may see some changes. What we have, we've got a couple of handouts that we provide people on what typically is being paid to veterinarians and what might be paid to a technician or to an over-the-counter doctor. I mean, we see situations where the owner veterinarian is the default provider in the practice management software, and we'll go in there and we'll see a veterinarian that works 2 days a week getting $1 million of production, and so there's certain circumstances where if the crediting is inappropriate, it absolutely is going to be changed, and that's one of the biggest hurdles. What I would tell you is improper crediting more often than not will decrease your EBITDA rather than increase it, because you're going to have veterinarians that are being credited with more services than they're actually producing, which is going to drop wages to their bottom line, which is going to decrease your EBITDA. We deal with that on a very regular basis, and we routinely tell people to try and get us a 3 or 6 month run rate with proper crediting, so we can at least have some backup if we're trying to modify that.
We're about the top of the hour here. One quick clarifying question that came in around COGS, C-O-G-S. Steve, I'll let you handle that one just to define that for us.
That's cost of goods sold. So that's your drugs and medical supplies, your laboratory expense, buying pet food, and those sorts of things. So COGS is just an abbreviation for cost of goods sold.
Great, thank you. Gary, any closing comments?
Now, my main thing I was going to tell everybody was that this is a great series that we've got going on. We've got six topics in this series, and this is all about educating people about what the whole process is like. There's so many different facets of it. We've got some really good stuff on the website. If you go to our knowledge base, all the webinars that we do are posted there. I can't imagine anybody that has an interest in the valuation or how you calculate it or the transition of a veterinary practice couldn't find 2 or 3 things there that they think are an area that they could get educated on. So, we're here to try and help you work your way through the transaction, get you educated along the way, do an evaluation on your practice. you know, if things make sense after all that, we do some personal planning with you and practice work with you, then we do an engagement, and then we are on the market with you. And this is all about trying to figure out what is right for you and your practice, because this is a great market. I mean, there's a lot of things that are going on good if you're a seller in this market. Figure out what makes the most sense for you, for your practice, for your staff, for your clients, and let us help us put it together in a financial manner, and then let's go ask for it. Because, you know, I think it's really helpful for you to understand what you want out of a transaction. And, you know, in the market today, there's a lot of people that will accommodate that, but you have to figure that piece out. So it's not all about price. We say that all day long. Half the transactions we do don't go to the highest offer, because all the rest of the stuff matters. And it's so many different layers to transactions now. Just get educated along the way, just like you're doing today.
Hey, Gary, one quick question came in while you were talking there. It'd be a good way to kind of close the session. Is, so what's your average success rate of getting a practice sold, and how long does it take to close the sale?
Our success rate is coming down because we're doing more practices. What's happened the first couple of years that we were doing this, when we were putting groups together, we were doing 15 to 25 practices a year, and we pretty much had 100% success rate. Now I would tell you we're probably 85 to 95%. We've got one we're selling next month that we've been working on that practice for 2 years. So there is a lot of times circumstances which can arise that will dictate whether you're going to be successful or not. It could be your valuation isn't where you need it to be. It could be that you've got some board issues, that you've got staff issues. There's so many things that can come up and affect your transaction. What we can tell you is, if we do an evaluation on you, we can give you a much better idea what our success rate is going to be. We want to make sure that what you are expecting lines up with what the market is likely to give you. And we want to understand what kind of terms and things you're looking for. When we get to that point, we're gonna look at your expectations, and we're gonna tell you whether they meet what the market will do and whether you should be doing anything. This is a lot of work for everybody involved, for you and for us. We've got no illusions that it's going to be easy, but our sentiment is that we should go down the path and do the work if it makes sense, if you're in the right place at the right time in your career and your practice. In that vein, we're pretty close to 100%. But some people that come in the door for various reasons, either they or their practice aren't ready, and we try really hard to help you discern, where you are in that path.
Great. Thanks, Gary. Glenn, Steve, thanks so much for taking some time tonight. It was a great presentation. Everyone, thanks for joining us. Please go to our website, take a look at the next couple sessions in our series. We look forward to seeing you in the future. Have a good night.